Joining us from CommSec is Tom Piotrowski. Tom, as we have just heard there, possibly a rocky start this week as we await that US Federal Reserve's rate decision.
Danica, it was always going to be a challenging couple of weeks, the previous week and this coming 5-day window in terms of the markets navigating some important risk hurdles. So as we've just heard, the US Federal Reserve adjudicating on rates on Thursday morning local time, and then the inflation figures midweek. They really are the high point in terms of what we've got to get through on the challenges. So that is why the markets took fright on Friday. So we have been seeing interest rate markets moderate and trend lower over the course of recent weeks because of some encouraging figures where the US CPI is concerned. But then what we saw on Friday was elevated producer inflation numbers, and that's what saw the short and long-term interest rate markets sell off in the US in particular on Friday. That created headwinds for stocks. The Nasdaq was the biggest casualty of that, arguably down by around 0.7%. In weekly terms, down by 4%. The S&P 500 down 0.75%, and in weekly terms down by around 3.5%. So that sees the local SPI futures down by about 0.5%. But what will be interesting is that last week some of the most improved stocks were the mining and materials stocks. So that story around the reopening of China has sustained that group. It's a question of whether or not that continues into this week when investors will be a little more cautious. And the other thing that stood out last week was that steep sell-off in energy prices. So both the US and European benchmarks were down by around 11% in weekly terms, and that is why you saw the underperformance of energy stocks. They were amongst the worst performers. So it's a question of whether those sectors are able to at least consolidate in the face of what's going to happen this week.
Okay, Tom, thank you.